Yes.
Let's go ahead and take on this example on accounting standard number 9. Now, I've taken this example from the CA final practice manual and very much important for CA Inter as well. Go ahead and let's take on this question. Yes, ma'am.
Yes. Moon Limited entered into agreement with Sun Limited for sale of goods of rupees 8 lakh at a profit of 20% on cost.
So let us assume that you guys represent Moon Limited and you are selling goods costing rupees 8 lakh. Costing, they must have given that wording, right? Goods of rupees 8 lakh at 20% profit on cost. Now, what is 20% on rupees 8 lakh? It is 1.6 lakh or 1,60,000. That means you are selling goods costing rupees 8 lakh. You are Moon Limited. To me, I am Sun Limited for rupees 9,60,000 on 1st Feb 2014. Next.
Yes, sir. The sale transaction took place on 1st Feb 2014. On the same day, Sun Limited entered into another agreement with Moon Limited to resell the same goods at 10.8 lakh on 1st August 2014.
It's on the same date. Now we sign one more contract. What is the first contract? You selling goods to me for 9,60,000 on 1st Feb 2014, right?
Yeah.
We sign one more contract, that is one more agreement, wherein I'll be reselling the goods or you'll be repurchasing goods from me after how many months? 6 months. On 1st August 2014. For how much? For 10,80,000. Now at this point, as an accountant, you should understand, you should actually have a doubt. Now, why would anyone sell the goods for 9,60,000 on 1st Feb 2014 and repurchase the same goods for 10,80,000 rupees, 1,20,000 extra after 6 months? Is that fine? Next.
Yes, sir. State the treatment of this transaction in the financial statement of Moon Limited as on 31st March 2014. The predetermined reselling price covers the holding cost of Sun Limited. Give the journal entry as on 31st March 2014 in the books of Moon Limited.
So you haven't asked the past entries in the books of your company, that is Moon Limited, right? For the year ending 31st March 2014. So this example is based on AS 9, that is revenue recognition. Now please refer to the verbatim. I'll show you this particular example is based on this particular illustration. Now refer to AS 9, the verbatim, like a bar act, right? This is a accounting standard, the text. In that, you have some 14 paras in the standard. And after all the 14 paras, you have illustrations. In that, A relating to sale of goods. In that, A5, point number 5, let's read what is given.
Yes, sir. Sale or repurchase agreements, that is where seller concurrently agrees to repurchase the same goods at a later date.
Who's the seller? Moon Limited. Okay. Concurrently agrees to repurchase the goods, right? In this case, what? You are going to sell the goods for 9,60,000 and repurchase the goods for 10,80,000.
For such transactions that are in substance a financing agreement.
It's a financing means what? As if you borrowed 9,60,000 from Sun Limited and you want to repay rupees 10,80,000 after 6 months. That 10,80,000 includes the loan you borrowed plus interest and also any cost I am incurring to hold the goods, right? Holding cost.
So the resulting cash inflow is not revenue as defined and should not be recognized as revenue.
That means on 1st Feb 2014 in your books, the entry should be not bank to sales. for 9,60,000. What is the entry? Bank account debit 9,60,000 to loan from Sun Limited. Is that fine? It's a financing arrangement and not a sale transaction. Is that clear?
Yes, sir.
You are not supposed to recognize revenue in your books. Got it?
Yes, sir.
Now let us go ahead and take on the solution to this.
In
Yes,
the
ma'am.
given case, Moon Limited concurrently agreed to repurchase the same goods from Sun Limited on 1st Feb 2014. Also, the reselling price is predetermined and covers purchasing and holding cost of Sun Limited.
Purchasing and holding. Basically, I'm charging you for the 9,60,000, what I gave you, and also for holding the inventory. Next.
Hence, the transaction between Moon Limited and Sun Limited on 1st Feb 2014 should be accounted for as a financing rather than sale.
Is that fine? It's a financing, not a sale. Now just check the entries. I'll run through the entries, okay? On 1st Feb 2014, the entry should be bank account debit. Money comes in. To loan from or advance from Sun Limited. It's a liability. That is a bank account debit. That is, you can say, increase in asset, right? And also increase in a liability. So a bank account debit to loan from Sun, or bank account debit to advance from Sun Limited. How much? 9.6 lakh rupees in lakhs. Then for the 2 months, you are supposed to accrue the interest, right? So we know the interest is 1.2 lakh, which is 10 lakh 80,000 minus 9 lakh and 60,000, 1 lakh 20,000 or 1.2 lakh for how many months? 6 months. What is for 2 months? Feb and March. So 1.2 lakh into 2 divided by 6. How much you get? It is 0.4 lakh. For 0.4 lakh, what is entry? Interest expense account debit. So can we write finance? Charges account debit. It's all the same, right? You either write interest expense account debit or finance charges account debit is an expense debit to interest payable, or right to increase amount due to Sun Limited, to advance from Sun Limited, increase the liability. How much? 0.4 lakh.
4 lakh.
Then one more entry will be profit and loss account debit to interest expense, or P&L to finance charges, transfer the interest expense to P&L. Is that clear? Got it?
Yes, sir. Yes.
So guys, with that we complete this example. If you refer to the 3 entries, you are supposed to treat the money given by Sun Limited to your company as a loan. It's a financial, it's a liability. It's a financial liability, that's a loan. And then you got to recognize interest in your books, and that will be transferred to profit and loss account. Now in this example, if you notice, the inventory that you sold to me, it is not a sale at all. You can say that the inventory has been given to me as something called, what is that? Collateral. Basically, the inventory has been hypothecated. What is that? Hypothecated. It is a hypothecation of inventory. The inventory has been given as a security or collateral for the loan your company borrowed from Sun Limited. Is that clear?
Yes, sir.
Therefore, please remember guys, in your books, in your balance sheet, on 31st March 2014, you will show the inventory rupees 8 lakh. You will show inventory rupees 8 lakh, but you should disclose the fact that this inventory has been hypothecated. Is that fine?
Yes, sir.
You have to disclose that this inventory rupees 8 lakh has been hypothecated. And of course, on the liability side, it will show the loan amount is a loan secured by stock and trade. Is that clear?
Yes.
Got it? So that is the note you have to give. Remember that. And these are the 3 entries you have to record in your books as a Moon Limited. So with that, we complete the solution, guys. Bye-bye.